Welcome to the Daily Drawdown, where soft payrolls meet an expensive, very real AI build-out. The market got two messages at once. The labor market is cooling, and corporate spending still isn't. That mix pushed stocks to records, cut September hike odds, and sharpened the divide between AI winners, AI spenders, and everybody else. July payrolls fell by about 23,000, and the revisions took another roughly 103,000 off prior months, so the report was softer than expected on both the headline and the trend. The unemployment rate dipped, but part of that came from lower labor force participation, around 61.4%, so this wasn't a clean improvement in hiring conditions. Wage growth at roughly 3.2% year over year doesn't point to a fresh wage inflation problem, which is why the next CPI, PPI, and core services numbers matter more for the Fed than one noisy payroll print. Markets cut September hike odds into the low to mid 40% range, but later meetings are still live because the Fed is likely to focus on trend labor data and inflation, not a single monthly surprise. The bigger read-through is a low-hire, low-fire labor market. Hiring is weak, layoffs are still contained, participation is soft across cohorts, and the composition is shifting across sectors. Stocks ripped higher after an oversold July. The S&P 500 closed at records, the Nasdaq reversed earlier weakness, and small caps and cyclicals started to participate, which matters because breadth improved. This rebound looked less like a brand new economic regime, and more like pessimism getting unwound on strong earnings, technical support around major moving averages, and a momentum rotation back into risk. The caution is that complacency came back fast. The VIX dropped below 15. Index implied correlation is unusually low, and single stock moves are doing more of the work. That's great when you're long the right names. It's less comforting heading into the seasonally tougher September-October window with bullish sentiment rising again. So the split on the street is simple. Some still see meaningful upside. Others want selective hedges or trims because policy, seasonality, and concentrated leverage can still bite. The AI build-out remains enormous. Speakers were talking about roughly $2 trillion and maybe as much as $3 trillion of AI-related capital spending compressed into just a few years. That money is already driving demand across data centers, semis, memory, power equipment, and industrial inputs, and a lot of it is already financed or committed, including fresh bond issuance from the hyperscalers. That makes the near-term construction wave relatively sticky, even if nobody can pin down the exact monetization timeline yet. The bottlenecks are increasingly physical, especially power. Behind-the-meter turbines, fuel cells, and any infrastructure that gets a data center online faster are commanding a premium. Memory and chip capacity decisions matter too, because bookings and expansions now will shape the next pricing cycle. The market is getting stricter about AI claims. Companies showing a path to revenue or measurable productivity gains are being rewarded, while pure spending stories without payoff are losing credibility. Enterprise software has been part of the rebound. Names like Atlassian, Cloudflare, Twilio, and Palantir pointed to stronger bookings, larger commitments, or AI use cases that actually expand demand. The cleanest test is economics per employee. Airbnb was cited as the kind of AI-native story investors like, where headcount stays flat and revenue per employee rises. This ties into a broader rule for this tape. Management credibility matters. Investors are willing to pay up for leaders who guide cleanly and deliver, and they're quicker to punish repeated misses or shifting narratives. The next 12 to 18 months may be the period of maximum vulnerability on AI security. Capabilities are improving faster than defensive systems are adapting. Concerns intensified after OpenAI paused Astra and testing incidents suggested agents could follow instructions to find vulnerabilities or access systems. The main threat isn't a rogue model acting alone. It's malicious humans using stronger models, which is why the practical focus is guardrails, outside safety testing, export controls, machine identity, data governance, and runtime behavioral detection. There's a parallel warning in biotech. An Arc Institute study showed models trained on about 15,000 bacteriophage sequences could generate novel genomes, including several viable ones, proving AI can accelerate biological design in ways that are useful and plainly dual use. This buildout is now large enough to reshape local economies. In counties with hyperscale data centers, studies showed new home construction and home values rising roughly 50%, reversing broader declines in some areas. The job count per site isn't huge on a pure headcount basis, but a 500 megawatt facility can still support 500 plus on-site workers and a much larger ring of indirect demand through infrastructure, housing, and services. The pipeline remains large, with around 40 data centers under construction and another 100 sites planned, and capex strength is broader than AI alone. That spills directly into metals. Copper has surged as AI joins grid investment, defense, EVs, and infrastructure as a demand driver, while supply stays structurally tight because bringing major new mines online can take roughly 17 years. Gold is also benefiting from lower hike odds and central bank buying, with streaming and royalty firms using the backdrop to put capital to work. Earnings season has looked unusually strong, with S&P 500 earnings growth around 50% and high beat rates. But there's an important asterisk. Tariff refunds are materially inflating profits this year. More than $100 billion has been processed or paid out against roughly $166 billion owed after court rulings, and the beneficiaries include companies like Apple, Disney, Under Armour, and Columbia Sportswear. That helps current earnings, but it muddies the signal and sets up tougher comparisons later. So guidance quality and recurring metrics matter more than one-off boosts. Trade policy is also reshaping commodity and shipping markets in real time. Threatened tariffs on things like refined copper have pulled imports forward, tightened futures structures, and added volatility. And shipping through the Strait of Hormuz has dropped sharply amid regional conflict, forcing reroutes that add weeks, increase freight costs, and strain logistics. On the consumer side, spending still looks healthy but value-conscious. Back-to-school spending is near record levels, but the winners are skewing toward value and mid-tier brands. The same trade-down pattern is showing up in autos, where luxury share slipped to about 13.3% of U.S. sales in the first half, the lowest since 2020, even as buyers keep overall transaction prices high by choosing well-equipped mainstream SUVs and pickups. Fast food is splitting on execution. Burger King posted strong same-store sales gains on remodels and value offers, while weaker chains exposed how much pricing architecture and operations now matter. At the speculative end, SpaceX-related securities jumped after the first lockup expiration produced less selling than feared, but enthusiasm about market position and retail demand is separate from the valuation question, especially with more lockups ahead. DraftKings also rallied despite missing estimates because investors focused on reaffirmed guidance and optimism around prediction markets, though skepticism remains on stickiness and regulation. One legal risk worth watching is Meta. A New Mexico court ordered the company to contribute more than $500 million to a teen mental health fund and impose tighter protections for minors, and Meta plans to appeal. If similar cases spread, the issue stops being a one-off headline and starts looking like a larger compliance and capital allocation drag. On the labor policy side, a proposed AI tax tied to unemployment is still early stage, but it shows where the political debate is heading if tech-driven layoffs keep scaling. That's the brief for today. Softer jobs, easier hike odds, a broader rally, and an AI spending cycle that's still colliding with physical limits, legal risks, and real monetization tests. You're listening to the Daily Drawdown. This episode was generated by Podkey. Create your own at podkey.fm.